Hey, April, good to see you. Today, we're talking about how to weather a market correction and kind of a market outlook. As we knew already, 2022 is going to be a turnaround year following the stimulus and rally of 2020 and 2021. And the purpose of doing this outlook is not to predict, but to prepare. Brookstone CIO Mark DiOrio has already said we should expect volatility and a correction, perhaps even an echo bear market, which is a correction of 20% or more. What are your thoughts on this?
Hey, Erin, thank you very much for having me. And he's hit the nail on the head. We're due for some volatility. It's a natural part of the market cycle. And the question is how we're going to handle it. It's not a matter of if, but a matter of when we're going to see a correction. It's a normal part of the market cycle, as I mentioned before, but we are certainly going to see additional volatility in 2022.
And it's good just to know right now so that we don't make any emotional decisions because, of course, the markets have already been volatile. The Fed will be raising interest rates, and that monetary policy is a key driver of asset prices. So inflation doesn't run away. So, how are you helping your clients address these risks?
Sure. Well, first and foremost, you've hit the nail on the head with making sure that we don't make emotional decisions, and we'll touch on that again in a little bit here. But it's really important to make sure that you have a well diversified approach, and that approach does not need to be buy and hold. That's not what I'm saying, but there does have to be a discipline, and there does have to be a specific strategy in place for those volatile times that we know that we're using alternative investments to better diversify and to help us weather that storm. So whether that is structured notes, whether that is a fixed annuity component, whether that's buffered ETFs, there are a lot of ways that we hedge that portfolio so that we can make sure that we're not as subject to the market volatility that we're likely to continue to experience. But at the same time, we have to also have the opportunity to keep pace with the inflation numbers that we're seeing today.
Right, right. And so I know what you wanted to talk about here, which is behavioral finance, right? So this was a graph that I found from 2021 when the markets were high and we were all feeling euphoric. But as you know, April, during market downturns, people tend to panic and sell. So what are we looking at here and where do you think we are right now on this chart?
It's a little bit difficult to say right now because I think we're really at a tipping point. But,
Yeah.
when we had all of the stimulus coming through, we were certainly in that euphoric phase. I think we're probably right around that fear phase right now. I think people are getting fearful. We might be really transitioning, kind of teetering on that next phase of desperation. But the important part of this is to make sure that we don't follow human nature. And I know that sounds counterintuitive, but there's a great study out there that is released on an annual basis. It's called the Dalbar study. And what that study is focused on is human and investor behavior. And, ideally, if we all had a crystal ball, we would buy at the lowest day and sell at the highest day if we knew exactly what was going to happen. But human behavior is actually exactly the opposite. That people tend to buy when they're feeling euphoric, when they're feeling confident, and they've already missed a good portion of the gain, which also drives that euphoric stage, drives the market during that euphoric stage. And then when we have downturns is when people panic and when they sell.
Right.
And that is one of the primary reasons that individual investors often fall significantly behind performance-wise than institutional investors do.
I know it's so hard to take the emotion out of it, which is why speaking with you always makes me feel better.
We're here to help, and having a well-defined strategy and investment discipline that, as I always say, that does not mean buy and hold, but it does mean having a well-disciplined strategy that you understand,
Right.
that you have a strategy in place to take advantage of volatility and to help you mitigate that downside risk, but also to participate when things are going well. And in challenging times like we're in right now, that can certainly be a little bit difficult, but there are a lot of strategies that can be utilized to help you better diversify and better weather the storm.
Yeah, well said. So if somebody would like to talk to you, April, either about those risk reducing assets that you're offering clients, or maybe just want to, again, talk this through so they don't feel so emotional about this, what's the best way to reach you?
Sure. Well, there are a couple different ways. You can reach us anytime at our website at the retirementfamily.com, or you can give either one of our offices a call and we'd be happy to help.
Perfect. April, thank you.
Thank you, Erin.